What's up, y'all? So here's an awesome exercise that you can do to capture some great runners before they happen. So people often get caught with fundamentals this or technicals that. However, they often forget that these are the side effects of people's motivations and emotions. So people want to buy into a story, not just pure numbers like earnings per share, etc. A classic example is the electric vehicle industry recently. So people want to invest in a disruptive industry and they like the idea that electric vehicles are saving the earth. So that's a more sexy story than buying gas cars. So by listening and understanding the story between the various players in the game, you'll have a way better time finding the best opportunities suited for you. So here's a fun little exercise you can do weekly on Sunday before the market restarts, or even daily if you wanted to. Try to imagine being from the perspective of each of these players, their emotions, motivations, etc. So let's start out with institutions / prop firms. So what do they want? They want something that's very safe, scalable, that they can use a lot of funds. What they don't want is something that is not volatile, so that investors stay interested in the fund. Something that is not unscalable, like penny stocks, etc. Okay, so for example, in this market, I'll reset it. Tech has been going up a lot recently, the past year. So big firms may want to short tech, and they may want to go long in beat down sectors as the vaccines roll out, like retail, restaurants, entertainment, etc. Or even beat down stocks and other global industries like Chinese stocks, Baba, JD, XP, Lee, etc. Okay, now let's go into the retail traders. So these are people who trade professionally, but not for bigger companies, and they usually have smaller amounts. So they want something that is not necessarily scalable. So you got your penny stocks, hype momentum plays, like SPACs. SPACs are also scalable, but they're also very cheap too. And then penny stock examples include bingo, stuff like that. But then you also have your swing traders too, so probably following big money like the prop firms, and then they're probably looking at earnings, conferences, and other stuff that the bigger money can follow too. Then you also have your investors and stuff. So people who hold it for a long time. These could also be your regular masses. So maybe they'll swoop in on majorly beat down stocks. Same thing with big institutions, like recovery sector, like your retail, restaurants, entertainment, etc., and so on. So let's move on to the next one. The next one is regular masses. So people who don't really research that much. So think they probably research or invest in bigger funds like ETFs, for example, SPY, QQQ, Vanguard ETF, I forgot what they are, BTI, etc. And then they probably fall for pump pump and dumps. So you got your, let's see, Teos, bingo again, and you got your Bitcoin related ones like Mara, Rights, etc. So for the regular masses, as they don't really research technicals or fundamentals, they really want to buy into the story, get rich quick. So they want to buy into the get rich quick story of buying penny stock, hoping it jumps up and bunch, or they follow trends or hype trends, like your Teslas and other stuff that they don't really know much about. So we dive deep into what you think a person that doesn't research would want and their natural tendencies. Okay, now we got our last one. So for market makers and brokers are, for example, like a Webull, Thinkorswim, where they facilitate the interactions between buyers and sellers, like a Robinhood also. So these are people who want lots of volume. So more interactions. So more interactions means more money for them. So for example, Robinhood promoting penny stocks are trending, and others getting lots of attention. So the more people trade, the more profit they make. This doesn't necessarily mean they want the customer to lose money or make money. They just want the customers to stay in the game. They want the customers to keep coming back and doing transactions. So brokers aren't necessarily evil, good. They're kind of more neutral. They just want to make the most profit by having the most amounts of transactions possible. Okay, next one we have the market makers. So these are people who facilitate liquidity in the markets. So they create markets for their customers. So let's say, for example, there's a ticker that's kind of relatively unknown. Market makers may be hired to create buys and sells, and then these buys and sells get picked up on different scanners by other retail traders and institutions, and then they come in and they start buying the stock too, they start selling it. So that's basically what they do. So what you can take advantage is you can go in the direction of the market maker if there's a clear trend. So let's say, for example, the market maker puts up a huge wall, like a $5 million wall or something. You could short at that point where around the same price level, and then it'll probably decrease down. You combine it with other indicators like your technicals, RSI, etc., and that'll help create a better outcome. Or you can go the opposite way if their direction doesn't hold. For example, if they place up a huge $5 million wall, but then another market maker comes in and they take out the wall, you can go long right away and ride the short squeeze up, as other players would probably think the first option where they thought that stock would come down because of the huge wall. But now that it doesn't, they have to cover their position, causing a short squeeze. All right, so these intersections would be very important. The more you can intersect people's motivations and behaviors, the more you can find that golden key area where the best opportunities lie. So, for example, a trade that our Discord is in right now is NEO. So there was a common stock offering, so that caused people to sell a bunch. So it decreased down to a lower price level, like around 40. The big institutions swoop in. So I just write this out. So a couple weeks ago, NEO stock offering down to 40. Institutions swoop in, release news conference, regular masses / retail traders swoop in, and then the market makers, they could be in different areas where maybe they were in the beginning where they put up huge walls at around 41, 42 so that the big institutions could come in and get deals before the regular masses did. Or they could create other opportunities too in the future. So maybe they'll create huge walls after NEO Day or even before NEO Day if they know that NEO Day on January 9th will be really good. So that's a prime example, and let's think of other prime examples. We also have IPOC2, IPOC. So a bunch of institutions, big boys, loaded up at around 10 or before it went public. Bigger players kept coming in, regular masses see it at around 10.8. They swoop in, retail traders too, and then it's gapped up to like around 17. So the market makers for a while, which I've noticed, they kept it around 11 for 1 or 2 weeks for big players to load, and then after that it started gapping up later after all the bigger boys went inside the stock. And then there's also BABA too. It got excessively beat down off the restriction news from Jack Ma and so on. So those are 3 main examples that you can use. So try to really zone in on your natural strengths, and then try to find a key area where you really empathize with the other players, the big institutions who want to scale in safely, the retail traders who want to make money based on their edges, the market makers, brokers who want as much volume and liquidity in the market, the regular masses who want to find out one stock that will explode and get them rich quick. So if you intersect and find the motivations, behaviors between these 4 players, you'll be able to maximize your reward to risk potential to combine with really maximizing your natural edges. So hope these tips help, and talk to y'all next time.